Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Rob Chrisman. Topics on today's episode include the latest from DC that's impacting the mortgage industry, my interview with Porchlight's David Wells on how the mortgage industry is shifting from a human-driven, siloed process to a fully programmatic API-powered model that automates repetitive tasks, streamlines capital markets execution, and empowers loan officers to focus on high-value, trust-building relationships, and just what sort of deterioration we're seeing in the labor market.
Thanks to today's podcast sponsor, Gallus Insights. Mortgage KPIs automated at your fingertips. Gallus allows you to turn data from your various databases and systems into automated business intelligence and actionable insights. Learn more at gallusinsights.co.
Apparently, you can't use beef stew as a password. It's not stroganoff. How's your privacy? Or another question. Why wouldn't you tell your recent borrower to freeze their credit after the loan was done? TransUnion has filed data breach disclosures, and according to the filings, millions were affected through Salesforce on July 28, 2025, and it was discovered a couple of days later. Data breaches are always fertile grounds for attorneys, and speaking of legal matters, Federal Reserve Board Governor Lisa Cook did not ever commit mortgage fraud, her lawyer said in a court filing, bolstering arguments why a judge should temporarily block President Donald Trump from firing her. Quote, any of Cook's statements that she made on mortgage applications, which Trump has cited as the reason for her termination, do not give the president legal cause to remove her. Lowell said multiple government entities received her mortgage details before the Senate first confirmed her nomination to the Fed in May 2022. Nearly 600 economists signed an open letter warning that her potential firing threatens the Fed's independence and erodes trust in a key pillar of the U.S. financial system. And President Trump asking the Supreme Court to rule on the legality of his tariffs is stealing the headlines, but U.S. labor market data continues to signal cooling momentum. Yesterday's JOLTS report showed job openings fell to 7.181 million in July, the lowest level in 10 months and the weakest since 2021. The job openings rate dropped to a cycle low 4.3%, and for the first time since 2021, there are now fewer than one job opening per unemployed worker. Both hiring and layoff rates remain subdued, suggesting a cautious stance from both employers and workers. Attention now turns to the upcoming employment data, with several labor market data points today and the employment situation report from the Bureau of Labor Statistics tomorrow, expected to show that 78,000 jobs were created in August. For today's interview, I wanted to welcome to the show Porchlight's David Wells to talk about how the mortgage industry is shifting from a human-driven, siloed process to a fully programmatic API-powered model that automates repetitive tasks, streamlines capital markets execution, and empowers loan officers to focus on high-value, trust-building relationships.
I read enough bios throughout the week. So David, maybe introduce yourself, Porchlight a little bit. We'll dive into it deeper.
My first exposure to mortgage was the integration of countrywide credit. One of the biggest mortgage integrations, and it was a full tech play. Our whole idea was, let's bring in a loan origination system, put it in our branch offices, and bring the banking and the mortgage worlds closer together. You guys all know how that worked out. Not so good. But from that moment, became very interested in sort of mortgage and been down that path, and was still carbon copy and triplicates back in the day, and running to the photocopier to make deals happen. And as a technologist, I really thought there was a tremendous amount of opportunity there. And so spent a couple of years at some separate fintech companies trying to fix the problem, and realized really that the big problem of that front door we were talking about was it's controlled by the back door. And you can do as much as you want at the front end of this process, but at the end of the day, the lender controls so much of the experience that despite how great at technology you might be, your customer experience is always handcuffed. And so we got really excited about having that ability to bring that front door in an technology sense and integrate it with the back end processes. And that's really the only way we can make a dent in transforming the customer experience, is bringing those two worlds together. So we started Porchlight with that dream in mind of bringing sort of the technology of the front and the back together with one sort of really key underpinning in that we're not trying to replace humans. We still think this is a human guided transaction from both the loan advisor, loan officer, and the real estate agent. But there's a whole lot of people in between those folks that are doing technical, repetitive tasks that can be easily automated. But nobody was able to do it because they'd not taken the opportunity to bring front and back together on a single platform. Put all the data in one place, all the systems in one place, and try to really transform the customer experience, realizing that humans still need to be in the loop. Loan officers are an important part of the transaction, as are the real estate agents. So that's what Porchlight's all about, really transforming that consumer experience into, what the digital millennial expects. They are not going to tolerate the experiences that exist today. This new cohort of home buyers has high expectations for us. So we're out there trying to meet those expectations in the marketplace.
Mm-hmm. When I first started in the industry, I got out of I graduated University of Texas in the early 2010s, and I joined SoFi, and it was the talk of this end-to-end digital mortgage, the digitization of mortgage. And 10 plus years later, almost 15 years later, we're still talking about it.
Web 2 missed this space. We spent a lot of time talking about AI and all, machine learning, and the reality is there's still no viable Web 2 platform for real estate. And you have to ask yourself why. And
what does Web 2 mean?
Web 2 just HTML. Let's do an e-commerce platform. I want to buy and sell a widget, eBay, your basic transactional platform. And you could take this mortgage problem to a Stanford, computer sciences class, and they could fix it, right? But what they would find is when they go to implement, why won't it work? And it won't work because the capital market guys aren't on board. And until the guys that control the pot of gold, the guys that buy 80 to 90 to 96.5% of the house are on board, no technical solution is going forward. So a lot of what Trent's doing, technically is important, but it's also cultural. He's wrapping these lenders up and getting them to trust him, right? As being their guide, having a single repeatable process to access multiple lending sources. The way you use your credit card at eBay does not differ from the way you use your credit card on Amazon, right? But mortgage, you have 5,500 different processes to access different lenders, or really there's 1,400 big ones, but about 5,500 independent registered ways. So when you're a real estate agent or a millennial going to buy a home, the process is never repeatable. Each transaction is different because in order to access that guy's checkbook, you need to follow his process. And so what Trent's really done is herd the cats, right? He's put a bunch of lenders behind a common unified process and then made that accessible by API calls. That empowers a guy like me to go out and not worry about that piece and focus on the consumer experience and build on his infrastructure, a way for you to transact to purchase a home that is agnostic of the lender's processes. And so as a real estate agent or as a home buyer, my experience becomes very uniform and consistent and not dictated by the person that's actually funding the loan to purchase the home.
Yeah. Well, I think we're discussing there's two kind of big problems here, or issues with his legacy issues, and one is what you mentioned in your first answer, David, and subsequently just now, and Trent mentioned in the second answer, and that's capital markets. David said that the capital market essentially determines what the loan needs to look like. The other problem is the human element, which leads to certain inefficiencies or drives up costs. And I'm not advocating for taking away people's jobs here. I'm advocating for people being more productive through technology. Let's make that distinction. But let's address each of those problems one by one. David, your background is in capital markets. We've seen kind of a shift where capital is now more open to new products or underwriting methods, whatever it might be, incrementally and slowly. I've said for a while, historically, the industry has been very good at finding debt obligations, but not good at finding income sources. I might have a small home in the woods here, but they don't want to use that income, unless it meets certain parameters, whatever it might be. Can you talk about capital markets becoming more accepting of kind of newer products, newer ways of originating, how we're going to see kind of the mass shift, if it's a bell early adopters, whatever it might be, kind of where we are now and how you see it evolving through the remainder of this year and into the next couple of years?
For sure. And it's happening quicker than people think. So when you look at the GSE, in fact, my Chrisman newsletter today has a very nice piece about the GSE privatization that's going on. But, touching on sort of private credit as a totality, it went from a $400 billion marketplace to 1.8 trillion in private credit. Those guys are clamoring for access to good paper, right? And let's take a flip side to the GFC is this regulation has created a portfolio of paper on the marketplace that's near treasury quality. I mean, the underwriting standards and the regulation has a positive byproduct to capital markets, and that the paper we're all selling on the back end is pretty solid right now, more solid than it's ever been historically. So, this GSE privatization, is it going to be 50 basis points higher? It might be a nothing burger, right? We might actually see capital markets move to a more privatized model, create more competition. I'm a big free markets believer, that, we might not see that 25 or 50 bips hit, and that private credit might step in and fill the void, because the paper that we're writing is really high quality. So I think there's, a transformative time in capital markets. And if we can give them visibility to underwriting standards, visibility to overlays, then the shopping experience for the back end capital market guys trying to roll up mortgage-backed securities, they've got, a lot more faith in what they're looking at based on, the system's data. When they're shopping for paper, they really can run their scenarios and their filters and build their portfolios in a programmatic way on the capital market side. It's pretty exciting, Robbie.
The other part of what I said is about the human element here. And I think that's important. There's been talk of disruption for a long time. And maybe originally it was, hey, let's displace the real estate agent. And then we realized, hey, people want to be, walk into a house and have somebody hold their hand and tell them about the school district, yada, yada. Then it was, hey, let's disrupt the originator. Their comp is crazy, and a lot of this stuff can be answered through an AI chatbot. Well, it almost seems now we move past that to, well, the underwriter and the processor are the ones that can be disrupted. And I guess, David, I want your thoughts on if you think that's going to be where we stick, or if we're going to evolve to other parts of the process, where you see the biggest efficiencies coming from a human capital element.
Yeah, it's a great question. I mean, there's two sides to production, right? And there's production of the loan file. There's a production of the transaction that goes on the real estate side. And so the two roles that, and let me give you first the backdrop that we believe this remains a human guided transaction, that there will be humans in this transaction. It's too big of a purchase to be completely programmatic from the real estate agent side as well as the loan side. There's always going to be the need to have some human in there to give you that level of comfort that the biggest decision in your life, right, is a sound one. And I feel pretty good about it. Maybe someday this cohort, maybe showing my gray hair a little bit, will be very comfortable talking to an AI agent that says this is good to go. But I don't even trust AI right now on some of the things I'm using it for. But it's getting better every day. So I maybe dating myself a little bit. But we can change the role of those. So the two people, just to be totally transparent, that we're after are the processor. The loan processor is a Boolean person that is, taking guidelines, trying to translate conditions, get those conditions cleared, translate those conditions to meaningful responses from a client, right? That's the perfect use case for AI. We're not looking at AI doing any underwriting, but that kind of Boolean conditional clearing and translation is perfect. The loan processor is going to be dramatically impacted by the future. On the real estate side, they have a very similar guy called the transaction coordinator. He sits behind, 10 to 12 real estate agents and shepherds paperwork around, applies the same level of Boolean logic and or condition clearing, whether it be a cracked foundation finding or an appraisal finding or some other deal. That person also, is going to be displaced. It's just a fact of life. If my kid was in either one of those two jobs, I'd be saying, look somewhere else. The loan advisor role is going to change quite a bit, in that they, maybe a good guy's handling 4 to 5 files a month. That job needs to move to 30 to 40 files a month. And one of the things we can do is sort of segment their job a little bit, remove a little bit of the sales pressure, and transform them to more of an advisor, somebody who has a fiduciary responsibility to their client, not somebody who's transactional and looking for the best YSP to try to move this product onto their person on the other end of the phone. So rate transparency, pricing transparency, enabling loan advisors to act in the capacity of a fiduciary is what our tech platform is all about.
You speak with such certainty, and I won't say hubris, but we've thought that we could disrupt roles before. Are we already at the point where these roles are being disrupted that gives you the confidence to say that? Is there any margin for error? I could be wrong here with how it's evolving.
So we are in other domains, right? So my hubris is seeing it being successful in other domains, but that is why mortgage is the way it is today. People with my hubris are dead all over the place in this mortgage journey. But it takes a certain
Yeah.
level of bravado to tilt at the windmill. So I've got a Don Quixote complex for sure. But I think it's worthy. And what's driving me is that I don't believe the millennials will tolerate the experience, right? Today, you and I, like, we're still okay. We'll deal with it. Yeah, we'll fax it, whatever. But the new cohort, this 25 to 40-year-old group of people that is entering the consumer experience for the first time of buying a home, they will respect and maybe even pay a little higher rate if the consumer experience and the cleanliness of the execution, and it's on my phone and everything's in one place. It's not just rate, it's service, it's product features, it's all these things bundled together in a really experience. It's trust, right? My loan advisor is giving me the right advice and counsel on this mortgage, and all of that bundles together to be a really unique opportunity to take another shot at the windmill, Robbie. Like, the capability of like deterministic machine learning is going to replace underwriters at some point, but until the regulators are comfortable with the black box and you can explain why all these plumbers are being rejected from mortgage because AI figured out plumbers don't pay their loans, or it's redlining, or, whatever, until you can describe it like to the regulators, the sense of confidence, that's what the barrier going to be. And you can't really go out and just build your data set by playing. Right. And it's redlining all over the place and doing all this stuff. And so you can't train your model on real people. So over time, we have all this data. We will train models. Underwriters will become more efficient. They'll still need to be the check, but it's the perfect use case for AI. It's just the regulators aren't going to let it happen anytime soon, so it's not an area of focus for me. Because despite how brilliant a technologist you are, the Fannie Mae cash window is not going to take your file.
Yeah. David, I want to give people some background on how we got hooked up. And you've listened to my podcast for a while and you heard me talking about all these AI people and you're like, he gets it. What I have said for years is, why doesn't a marketplace exist in mortgage like we have for Google Flights? There used to be these travel agents and you call them and say, I want to go here, and they compare. Nowadays I type, SFO to John F. Kennedy, boom, up pop all my options from all the airlines. I go shopping for car insurance, up pop all my options for car insurance. I go look for a hotel on Expedia or Hotwire, up pop all my options. And obviously underwriting a mortgage is a little more complicated, but and there's barriers we've seen with, do lenders really want to put their rates up against their competition publicly? I'm wondering kind of if you could bring people up to speed on how your and my visions of the future of mortgage dovetail, and why it hasn't gotten there just yet.
Yeah, so that the travel agent analogy is a good one in that, the mortgage broker sort of plays that role. The difference is Visa is already underwritten, right? So when you go to make that transaction, there's no underwriting going on. The airline's just trusting that Visa is going to take care of the whole thing. So it's not the perfect metaphor. This underwriting occurs in two flavors. We have to underwrite the person. We also have to underwrite the collateral, right, that's backing up the loan. So it just muddies up the ability to make a smooth and elegant transaction. But the one I want to build on that you're hitting on is rates, and the inability for people to display rates in a way that allows honest shopping to go on, honest comparison to go on. And the reality is bankrate.com, isn't really serving a lot of value to a lot of people because, nobody's realizing that's a fake rate, right? That rate isn't my rate. That's my 780 credit score. I work at NVIDIA. I'm putting 22% down. That rate isn't real. Until we underwrite you, we don't know what your rates are, right? Until we see your collateral, we don't know what your rates are. And so rates become a really hard thing to be transparent about. And so the idea behind Porchlight is to bring that transparency forward. Let's move some underwriting tasks to the front. Let's bring the collateral data in so that we're seeing the collateral and the person in real time. And we're beginning the underwriting journey a lot earlier to get a sense of what we call sharper rates. The more information you're willing to put into Porchlight, the more certain I can be about your rate. But this goes back to sort of the FinLocker stuff, right? This FinLocker idea of realizing that the rate you see in the paper isn't real, right? They're educating you on your credit score, how to repair your credit, how a 720 to a 740 means a quarter point on your mortgage, right? It's a big deal. And so here's the steps you should take to prepare yourself for the home transaction journey. And that FinLocker sort of value prop on the front end allows people to understand when they're using a system like mine. Well, that's why I see 7.5 in the newspaper, but I'm 7.75, and I feel good about that. Like I'm not feel like I'm being taken to the bank on rate. So bringing rates to the forefront, Robbie, is something you've been preaching. And this marketplace environment is the only way to shop and compare. So the question about why doesn't it exist, gets into sort of like maybe they just don't want it to exist.
Yeah, there's definitely been some gatekeeping in the industry. What does it take for, mass adoption of what we're talking about? Is there a tipping point? Because obviously there's the bleeding edge has been happening for a while. When do we get to kind of tipping over to where this becomes more mainstream?
So I think I'll be real short, Robbie. I think it's a really important component is a trusted customer experience for shopping and comparing. And then just adding to your variable, the cash to close component, right? These are things I want to play with. I want to play with my rate, my monthly payment, and how much money I got to put on the table to close. I want to dynamically have an experience to dynamically model with that. And that's going to, translate into the consumer product that I ultimately buy.
The Federal Reserve's August Beige book painted a picture of economic stagnation, noting flat to declining consumer spending as household wages failed to keep pace with rising prices. While overall activity remained largely unchanged since the previous report, persistent uncertainty around tariffs continued to weigh on business sentiment, with nearly all districts reporting tariff-driven cost pressures, particularly on input prices. In response, retailers and hospitality firms increasingly turned to discounting strategies to sustain customer demand. Employment levels held steady across 11 districts, while 10 reported only modest or moderate price growth, reinforcing the view of an economy caught between slowing consumer momentum and lingering inflationary pressures. It's a packed economic calendar today, and it kicked off with several labor market indicators. Job cuts from Challenger Gray and Christmas for August revealed U.S.-based employers announced 85,979 job cuts in August, up 39% from the 62,000 announced in July, and up 13% from the nearly 76,000 announced in the same month last year. We've also received ADP employment for August, which came in at 54,000, below expectations, and weekly jobless claims in at 237,000, shooting higher versus last week. Later today brings final August S&P Global Services PMI, the ISM equivalent, Treasury supply consisting of $58 billion of 3-year notes, $39 billion of reopened 10-year notes, and $22 billion of reopened 30-year bonds, Freddie Mac's primary mortgage market survey, and remarks from New York Fed President Williams and Chicago Fed President Goolsbee. As a reminder, this is the last week of Fed speakers before the September 16th and 17th FOMC meeting. Additionally, the Senate Banking Committee will hold a nomination hearing for Stephen Miran to become a member of the Federal Reserve Board. We begin the day with agency MBS prices slightly better than Wednesday's close, the 2-year yielding 3.60 and the 10-year yielding 4.19 after closing yesterday at 4.21%. Let's wrap up with a joke and some housekeeping. I asked the bartender what the Wi-Fi password was, and he told me I needed to buy a drink first. So I said, okay, I'll have a Coke. He said, is Pepsi okay? I said, sure, how much is that? $3. I gave him $3, and then I said, so what's the Wi-Fi password? He said, you need to buy a drink first. No spaces, all lowercase.
Thanks again to Gallus Insights. Mortgage KPIs automated at your fingertips. Gallus allows you to turn data from your various databases and systems into automated business intelligence and actionable insights. Learn more at gallusinsights.co.